Hello, everyone. We are live right now. Good evening, everyone. Good evening. So great to have you this evening on another episode of Money Matter Live. And today we'll be talking about how to make your money work for you. But before we go into that, I'd like to just introduce myself. My name is Sandra Oko. I'm a Maxwell Leadership Certified team member, coach, speaker, and trainer. I'm a member of the Toastmaster. I'm an sales expert of over 20 years. I'm also a best-selling author. And today I want to take you into on how we can make money. But before we go into the show proper, I'd like to talk about what the show is all about, what we intend to do before we start. Thank you. Hi. Yes, in the Morning Matter Live, I want you to get ready to be inspired. With us today is already introduced myself is Sandra Uko. But before I get to speak and take us into the training, we start by, it's Money Matter Life where we try to train, we learn to live that rich life that we've been created, spread wealth. It's a talk show and a movement that is about helping people live a richer life as a result of becoming their best versions and their best selves by being financially literate. And today we're going to be talking about how to make your money work for you. And beyond that, in Money Matter Life, we focus on sales, we focus on savings, we focus on investment, the different types of investment vehicle you can put your money to work for you. We focus on real estate, life and health insurance, and the businesses you can do in the 21st century that we are now. And so today, I would be taking you into the class today on how to make your money work for you so that we can stop overworking ourselves. And I'm focused on the major and minor on the minor. So making your money work for you. How do you do that? A lot of times we have different people in different countries working 2, 3, 4 jobs, and still they're not able to make ends meet. The money is not even enough to take care of their bills, or rather even investing. So, but today I want to show you, I also want to discuss, we can discuss together. If you have questions, you can bring it at the end of the session today. But how we can stop overworking for money and how we can put our money to work for us. So I'll be taking you into the class today and the objectives. I'll be moving to the next slides. The next slide. This is a disclaimer. I'm not saying that I'm going to teach you, I'm going to, take your money and, invest for you. But there are better ways we can learn and how we can put our money in different investment vehicles that can yield for us. So I take you to the next slide. This is our objective. Thinking differently about money. Practice business ownership investing and generate passive income. There are several ways we can generate passive income. Easy process for finding investments to own. A lot of times we look at, what kind of investment can I get into? How do I get my money to work for me? I'll be discussing, taking you on that route. This is our objective today. Guiding principles for long-term success. These are principles that would guide you, in your journey to making your money work for you. So I move to the next slide. Why is growing money important to you? Why should that be important to anyone in the world? Why do you want your money to work for you? You can go to this slido.com, enter the code in order for you to get more details on why you want your money to work for you. And one of the reasons we want our money to work for us is the money you have. You don't want to just put it in the accounts in any banking institution, because we found that most of the banks, what they give you in return as returns on investment is little to take you on, as in is negligible and cannot be seen as an investment that you want to use to make your money work for you, make your money work while you're sleeping. So there are other investment vehicle that you can put your money and you can make as much as 20% and even much more. And so beyond just putting your money in the bank, with inflation, there's a lot going on this time around. Inflation would overtake your money. And so you don't want to just leave your money in a banking account. You know, the bank, it's easy for the bank to take your money, give to lend to others, make more money. But when they want to give you interest, they give you 0.01%. So you can imagine you have $100 and you're expecting that the return over investment every month should be 0.01%. That's very negligible. That cannot take you home. That cannot even meet the inflation of today. And so, even before we go into deeper, I want to talk about what is money in itself. Money is a legal tender in which we use in exchange of service. Money is gotten either we're providing when you provide a service and you're paid in return, or you sell a product. And so, there is no rich man today or anywhere who has made money without having a product or solving a problem. So you must have that niche that this is your niche. This is what you can do. This is your strength. This is the services you can provide to solve the problem, the present problem. This is the product that you can give in exchange to make money. So, in absence of that, there's no way you can make money. You can't even say you want to print money. You know, I already said money is a legal tender. It is used either in exchange of products. You know, you are giving out products and you're being paid back in money and services. And but you must have a product that's meeting a need for people to reach out to you in order to say, "Oh, I want your product." You must have a service. You must have a solution to a problem that you are solving that's making people, reaching out to you to give their money to get your service. So in all of that, we have to know how we can make our money work for us rather than having two, three, four, five jobs. And at the end of the day, this money is not enough. And that's why I explain about inflation. Leaving your money in the bank would do you nothing but more harm because inflation will overtake it. But the banks can, confidently give out your money and make more money on top of it. So I'll take you to the next slide. So this is a graphical representation. This is a data I want to share with you. It is shown that Chase Bank in itself would only give you 0.01%. These are data you can also verify on your own, but I got the data, you can get data anywhere in the world. And this is a US bank. Majority of the US bank, this is the interest rate you get on whatever investment, whatever money you leave in an account. We have the West Fargo, we have Georgia's Own, we have Bank of America, we have West Fargo savings, and others that will give you 0.15% depending on what investment you're putting. It is shown over time, this is the rates. So this does not edge, inflation. And that's why I said putting your money in a bank is the worst thing anyone can do in this age and time. There are a lot of investment vehicles you can embrace, and you must find out, do these investment vehicle match with your goals? Because it's a different thing for you to put your money in an investment and you need the money almost immediately. So you must find out, what investment vehicle can I put my money in? And how readily available are they? Should I need or have an emergency? Would I be able to withdraw my money out? And so that's why, in a nutshell, it is advisable that you decide which money or which percentage of your money goes into a long term and what percentage go into a short term. And understanding this will help you, knowing that a certain percentage goes for a long time. That means in 5 years and 10 years, you're not going to reach out, because the longer it is, the better the interest rates. And you want to find out, okay, what other investment do I need to put money so that I can have ready cash, I can have liquid. Every time I want to spend, every time I need to do a certain thing on a monthly basis, can I get an investment that will give me returns over my investments? You must find out these, and you must understand, what are your goals? What do you intend to achieve? Finding out what your goals are and agreeing and knowing what you want to achieve, then you can decide to take the next step of investing, deciding which investment to go. And it's also advisable that you don't put all your liquid cash into an investment. You must have your day-to-day expenses. You want to have cash to run your day-to-day expenses, because there are some investments, when you invest in them and you want to break them before the term, you pay a penalty clause, you pay a penalty. You pay for that. And you do not want to, you're investing your money, in return you're paying back because you're asking for the money much earlier than you should ask for, because there's a certain stipulated time that has been agreed that in 5 years' time you're not touching this account. And if it's the other investment you have, maybe it's a monthly thing, it's a yearly thing, you want to find out, can I live, can I manage, can I live within this frame without getting to touch the other percentage that has been invested in order to get liquid cash on a daily basis or on a monthly basis, is a quarterly. You need to find out what your goals are, what you intend to achieve, and how often would you need such funds. I'll take you to the next slide. Money is a tool, like I earlier said, that makes achieving your goal, your goals achievable. We found that a lot of people tell you money is like everything to them, but me, no, money is a tool for me. Money is a tool for me to achieve some certain results. It's a tool for me to achieving some of my goals. But beyond goals, you find that money is not everything to life. And that's why I was speaking with a friend last night we were talking about building strong relationship. I said we have two types of currency. We have the money currency and we have the relationship currency. And in this aspect, I said, which would you rather go for? You can lose money and make money back. But relationship, once you lose trust and lose relationship, you might not be able to get that relationship back. Rather, if you get the relationship back, it might not be as strong as it was before. So we have to weigh what would we want. Is it the money currency or the relationship currency? Yes, it is said that when you have the money in the old world, when you need people, your money cannot buy people. But if you have people, when you need money to even start a business and you have true and dependable friends, you're able to raise capital through your relationship currency. And so beyond that, relationship currency is of greater value compared to the money currency. So in this aspect, I said money is a tool. And money tool should be a tool. We should use money and put it as that tool. Money is not a man. It's not a life, or what would I call? Money is just a tool that will work for you. And if you don't put your money in the right investment vehicle, your money will just be there. And before you know it, inflation will override and take over your money. You get to the bank and you find out that rather than you making money, you're paying bank charges for monthly maintenance, and what you think I have $10,000, maybe in 5 or 6, 7, 8 years, the $10,000 you think you have has reduced to about maybe 7,000 plus, because there has been a monthly charge in maintaining your account. And this is so for all banks in the United States of America. There is a certain charge you need to pay on a monthly basis for maintenance. It is called maintenance fee. And that money will be deducted even without your permission, because it is written in their laws. And you sign up to the account, to that bank, in order for you to be able to run the account. So that is, you have to continually pay for those charges as long as the bank exists and as long as your money is in that account. I'll take you to the next slide. Use money to create passive income. What are the passive income? What I mean by passive income is while you're sleeping, while you're not working, your money is working for you. You can imagine you buy into a real estate and the real estate is already being given out for Airbnb. So whilst you bought the property once, the property is already yielding for you. You already have an Airbnb. People are renting it. People are going online and they're coming, they're booking, and they're moving into your Airbnb. And as soon as they are done, as soon as they want to book, they pay you. That's a passive income. You are not working actively. And why we call it passive? Because you are not involved physically. You're not actively involved. Your business is already online, is already digitalized. People can go online, pay with your credit card or whatever means, PayPal, for them to book to stay a night in your Airbnb. It's a one-time purchase, but of course, there is a monthly maintenance for your property, for your real estate, in order for it to stay at par and competitive with others. You want to find out what other Airbnb are doing for them to be attracting more customers, and to be more customers and more people to booking their Airbnb. You might want to find out, and that's by staying up to date with the news on Airbnb. And beyond that, you might want to buy land that you live for a certain period of time. And once this land is called land banking, you want the bank to appreciate Maybe you get a land for three, four, $5,000, and then after 5 years you want to dispose the land. That land over time has appreciated over 5 to 10 years. That land you bought for $4,000 could be sold for $40,000. That's a passive income. You've just only bought the land once. You're not actively involved in doing any day-to-day your 9 to 5 activity. When we call, say, the money is passive income, your money that you've invested in a certain investment vehicle is making money for you while you're sleeping, while you're not in town. That's another means of making money. And we have those into real estate who does fix and flip. There's so many you can do. You might want to find out, depending on the country where you are presently, treasury bills. I invested in treasury bills. I'll tell you the story about treasury bills, what I did, and how even when the bank folded, how I got my money back. But beyond that, real estate, you want to buy into real estate. There's a lot of fix and flip going on. People want to sell the hold buildings, and some, families, maybe they lost their loved ones and they have a lot of real estates, a lot of taxes they are paying, and they want to dispose some of the buildings. So, and some of them are sold out. And you have people who are also not able to pay their mortgage, and now the banks want to auction them. So sometimes you get those houses for lesser than you would get in the market value. And those are houses you can say, okay, I want to invest in real estate. I want to buy 2, 3, or 4 of these properties. I want to leave them, make them up, fix them to a great standard, then dispose them eventually. That you can do, and that's what's called the fix and flip. You fix the house, you allow it to appreciate, and you can sell. And in such ones, you make big chunk of money. You can buy a property for $70,000, fix it maybe with about $50,000, let's assume. And at the end of the day, you leave the property to just sit down there for a while, and then maybe after 1 or 2 years, you want to sell the property. The property you got for $70,000, fixed for $50,000. In all, maybe about 120, 130,000. You can as well sell for $200,000, and that you make another great chunk of money. And you can decide that what you've made, you can buy 2 or 3 other real estate, fix them up, sell them, and make good chunk of money. You can imagine if you made 70,000 in the first fix and flip, and you have 3 of these properties, you fix them up, and at the end of the day, you made like 50,000. Let's assume, because it's not constant. You make 50,000 in 3 places. That's already 150,000, and that's how you grow your money. And that's how you grow your money that just wants to actively, bought the property, you bought this property, you allowed it to stay, you fixed it, and you sold it, and you've made much more than you invested. And this is what you call the passive income. Your money is working for you while you're not actively working. When we call active income is your 9 to 5, where you have to be involved, where you have to be there in person to work to make this money. That's what we call the active income, And this one, you can find out that, God forbid, you're sick or you're feeling so tired, you can't make it work. That means you wouldn't make money for that day. So beyond just working actively, you need to have your money. You need to have your money saved somewhere, working for you and giving you passive income. And in that, you can make much more. Whilst not working, whilst sleeping, whilst in other things, you're involved in other activities, growing your business, you can also grow and make money passively. Then I take you to the next slide. Business ownership investing. You might have friends who have great businesses, and they're actually looking for investors to invest in them. In such cases, you can share your idea with other friends who you think have great funds, who can put in their funds, plug in their fund in your business. And you find that the business grow from 1 year to 3 years. Over time, you can see the plant here showing you the difference and how the growth of the business could, come out. So the business starts maybe in the first year with a certain amount of money, and the following year, which is probably the second year or 5 years, depending on how you structure it, you find out that your money over time is growing. And in so doing, every year, at the end of the day, you do your tax, you do your financial statements, and profit is being shared with these investors who have invested in your business. And that's what we call the business ownership investing. You have your business, but you have all the friends who and family members who are interested. And that's the reason you must be able to sell your business idea to people you think can be of benefit, who can invest in your business. You must have a great idea. And just beyond having a great idea, having a great business, you must be able to sell it to whoever that would have a better understanding, because you could have a great business if you do not know how to market the business or sell the business to any investor, prospective buyer, they won't be able to invest. So beyond just having a business, you must be able to market your business. You must be able to share your business idea with others. You must be able to sell it to others such that they're able to buy into your business. I'll take you to the next slide. So, buying public income producing instruments. We have dividend equities. There are different investment vehicles you might want to invest in. You might want to, invest in dividend equities, that's stocks. You want to find out about stocks. And before you invest in stocks, beyond just like, oh, this company is a great company, it's a blue chip company. You want to find out how they've done in the past years. In the past 5 years, have they been making profits? Because you might have a great business, but in the last 5 years have not done well. So you want to find out by reading, because a lot of times you don't invest in companies you do not know about. You must find out about them, find out who their CEO is, find out how they've been growing, how business have been for them. You might want to also invest in ETFs. It's called the exchange traded funds. You might want to find out more about it. And that's the reason why I said before you go into any form of investment, you must do your research. You must read about it, be comfortable. Do this match with your long-term goals? Do they match with your short-term goals? Are they investment vehicles to be involved in and this time? Am I comfortable? What's your risk ratio? How can you take risk? What's your risk? Because some people cannot, because we find that business is an investment that gives you the largest return are highly risky. So you must be able to find out what can I lose? How much can I lose? What's my risk ratio? And also you might also want to invest in mutual funds. Yes, I may call all this, I may give you much more details later. But beyond just me speaking, that's why I gave the disclaimer. I'm not saying bring your money for me to invest, but rather I'm actually showing you all the investment vehicles your money can be put into for your money to yield for you, for your money to possibly yield for you. You might also want to invest in fixed income bonds. Find out how many years, 2 years, 5 years. And the first thing I ask, what are your goals? What are your monetary financial goals? If you know what goals you've set, you want to either find out, can I wait for 5, 10 years for my money to yield? But we have some investment you can do. Maybe in 20 years, your money doubles. So you might want to find out, what are these investments for me? And we also have high yielding um, savings. Yes, these are high yielding savings, but they're not like putting your money in other investment vehicles. Yes, you make money from them, but not as much as you would if you were trading your money on your own, even, or if you were into real estate. These are just about five of them. I mean, there could be many more than you want to invest. Like I already said, I wanted to discuss and share my story when I invested in a treasure bill in my country. And that's why you must find out why you are investing. You're not doing it because all this are doing. My friends are doing this, I want to do it. They might have a higher risk ratio, and they might have all the investment, they might have diversified in such a way that even if they lose at one end, they have other funds in other investment vehicle making money for them. And this is what happened to me. I think me and my husband, we invested in treasure bills in my country. Then in treasure bills, you're being paid quarterly. And so you get your interest even before the 90 days elapses. So what we did was like we put a certain amount of money. So every quarter we get a lump sum that comes at the beginning of every quarter. So every quarter we were doing this, and we did invest in one of the discount houses. It's called the Express Discount House. But before then, we've been making money from that, and we had stories about the bank going down. And this investment house is owned by banks. Several banks come together to form, an alliance and they form different discount house. We have the consolidated discount house then, but we invested in the express discount house. So we were there for so many years. We were making money from our capital. We have the capital, but we were making money on it. And what happened was that we just heard that the company had folded. So for a year plus, we didn't have access to our money. But one good thing is that we have all our documentation in place. So with the documentation being in place, we were able to come, we went to the bank, we saw a notice where we need to make a complaint, a formal complaint about what is going wrong, that we can have access to our money. And we did all that. I think on that particular day, the board of directors were meeting, so they invited everyone who had invested, and we were there. And just, a few questions, interview questions, just to find out how much we invested, how long we've invested, and everything. We went there and we got done. But what happened? The money came back. We got the money back when they were ready after all the interviews. I think the CBN, that's the central bank of my country, Nigeria, was able to come together. I don't know how they did it, but I know we were paid. We were paid. But you can imagine if we had invested in a pausing scheme, if we had invested in something else and this bank folded, would have lost over 3 million. That was like 15 years ago, would have lost that whole money. But we were able to get the money in return. So whatever investment you want to put your money in, you must read about them, find out about them, find out what the insurance is, what is the payment capacity of the bank. Should anything happen to you, is it insured? These are questions you want to find out. So do not just go into any investment because people around you, this is what is the reigning thing, that this is what people are doing. Find out yourself, do your research, get comfortable before you put in your money. And if you're not too sure, you might put a certain amount and see how it works over the years before you put more. But I've seen people put all their money in an investment vehicle, and at the end of the day, when the investments flopped and everything went, they lost everything. So and that's why I said, beyond just making money, you can also lose your hard hand money in one day. So find out about what you want to do, what are your goals, and how you intend to go about it. Before we go into the next session, I'd like to just take a water break.
Are you thinking of how to publish your book on Amazon or how to get your published book to become an Amazon bestseller book? Dip Insight Books is the perfect in-between solution in transforming your ideas into a book. We can help you with all the complicated parts of publishing, such as process TO transformation. What we do: full manuscript evaluation, receive quality assurance edit, full copy edit and final proofread to remove spelling and grammar mistakes, oversee your cover design, create your interior layout, publish and distribute your book, lock down your marketing strategy. Ghostwriting, where there is no manuscript. Our goal is to help you publish your book promptly. Contact us today at 404-740-9091. Email us at info@dipinsightworld.com. To start the submission process, check us out at www.books.dipinsightworld.com and submit your details. You can visit our Facebook page at Dip Insight World.
So welcome back. Then I take you to the next slide, please. So this is your return over investment edges against inflation. And that's why you must find out what is the average return on investment on stock markets. Basically, generally, I think the base is 10%. So you might want to find out by 5 years, if I invest this year and the next 5 years, what do I intend? This is just an average stock market over the period of 2017 to 2021. So over 5 years, this is what you make market returns adjusted to inflation. And this is just historical returns are better than yields produced from bank savings. Like I already said, the yield you make from just saving your money in the bank is nothing compared to other investments you might want to put your money into. Then I take you to the next slide. So you can lose all your money in one day, like I rightly said, and it's too complicated. A lot of people said it's too complicated, and you don't want to take risk. So these are the fears that everyone generally observe. This is what people feel. The fear that I don't want to lose my money, I can't take risk, and what are the guarantees for me to make money? It takes a lot of money. This takes a lot of money. You might want to find out, oh, what is my fear rate? What can I take? What is the risk I can take if I invest this over time? What if this happen? You must find out, like I rightly said, what are your risk ratio? What can you take? What can you lose? So a lot of times in investing, you don't invest all you have in the savings. You decide I would rather want to do 20% because I'm not too sure, or this is the risk I can take. I want to do 100%, but you must find out what is your risk ratio? What's your value? What's your goals? What goals have you set for your money? What do you intend to do in a certain period of time? And how long would you be able to reach your goal in achieving that goal that you're set for yourself? Next slide. So this is just a timeline of the US stock market crash. You find that they've been crashed in all over the world globally. But a certain period of time in a country, this is what you get to. In 1929, we had a crash, and it was a strong word. Wall Street had a crash of there. And if you find out, if you look at it, was about 8 to 10 years, they had another word. In 1937, recession took place. And this year, I know a lot is happening. And in 1962, we had a slide. I took some years before we'd experienced that. Then in 1989, in 1987, there was another word. So these are just timeline of US stock market crash. So you might want to study these to understand the stock market, how you intend to, watch your investment in the stock, so that you know when to either cash out or when there's another, recession taking place, so that would you want to continue in that recession, your money going down, believing that over the years it will yield. Some people do not mind because it's a long term. They're looking at long term. They're not just doing it in and out to go. Some people want to do in and out. They want to just invest. After a certain period, they sell off and they come back. And so we have the 1990, there was an early 1990 recession too, before we got into 2000. These are all the timeline of US stock market crash. So you might want to study it in details in order to know. Like in 2020, we did have another one as a result, I think, of the pandemic. So you can see the several years. We have 2007. We also have in 2008. We had in 2010. And we also had in 2011. So in 2015, we had like a long gap from 2011 to 2015. And 2015 to 2020, we have like a 5-year gap. And this time around, I think a lot is happening in all around the globe. There's another proposition, as in another recession planning to hit the globe. So you might want to just take this as a guide to see, are you ready to go for the long term? Are you ready can you withstand the recession period? So that the moment you know the recession timeline, you either want to go through it and say, okay, I don't know how long this recession will be, but I'm ready to go through it. I'm ready to wait for my money to yield. Or you want to just cash out, cash out some certain amount of money, and then you want to use the money for something else. So you might want to cash out some certain amount because you don't want to leave all your funds there, because it might take another 5 years for the money to grow again. I've had friends who called me. I had a friend who's into gold. She's also into stocks. She's into real estate. She called me at a certain period of time last year or 2 years ago to tell me that almost everything she invested in crashed. But I told her just beyond, I also suffered that in cryptocurrency. You must also be able to go withstand this recession. Because I've seen people, I've heard stories, but I've not seen people who lost all they have gotten in one day. And some of them committed suicide. Some of them, became a shadow of themselves. So that's why, before you go into investments, it's not about your friends or your neighbor, what they're doing. It's about you. What are your goals? What do you intend to achieve? How are you able to take risk? What is your risk ratio? So in knowing that, you're able to say, okay, certain amount goes to this investment, the investment, because I said the higher the risk, the higher the return. So a lot of people want, oh, I want great returns. So they want to take, a riskier one. So you must find out what you're comfortable to take. Then I move to the next slide. We have no guarantees. Everything in life is a risk. Not even making an attempt is risky. There's a word I'm trying to just try to recall it. It's even risky not taking a risk. So that means life itself is a risk. So not taking a risk is riskier. That's and so when we have good risk and we have bad risk, some people operate recklessly. Some people don't care. Some people don't read about anything. They just put their money. That I would refer as bad risk. Good risk, you operate with uncertainty. Yes, but you're already sharing your portfolio. You are diversifying. You're either investing in real estate, you're buying stocks, you're also in bonds, you're also in stock market. You might want to do all that. And that's why I often would, excuse me, often I would always want to advise that you diversify. You do not put your money all in one particular funds. You want to have some in either real estate, the stock market, and bonds. You want to also save in life insurance. Where there's some life insurance that are tax advantage. You might want to find out more about that. You might reach out to me privately. I'll be able to guide you in that. You can invest. Have your money saved over a period of 10 years and 10, 15, 20 years, and you find out that your money is doubled and your money is not also taxed. And that's what is called the life insurance tax advantage. So these are things you need to find out. And that's the reason why I said you must be able to do your research. You can't depend, even the consultants you go to meet, you pay money. They have only read and they are equipped with knowledge to share with you. So I would say you're rather wasting your money going to meet with them. You can also study these on your own. But when it's up to meeting them for other financial advice, great. But finding out, oh, which stock will be good, when do I invest? You have to do this research yourself. And that's why we have good risk and bad risk. People just jump into the market. It might be a period when the stocks are high. The moment you jump into it, maybe it's a period when it's going on, it's coming down. You lose everything you put in. So you want to find out that in stock, buying of stock, you want to wait when they have a low season, when things are really falling down, when prices have really crushed to put in money. Then you find out that after putting in so much, and once the stock itself begin to increase, you begin to smile to the bank. So, and that's why I said you have to do the research yourself. Lazy people can go. No one who is lazy can invest because you have to be time conscious. You also have to be checking your accounts. You also have to be checking your stocks. You also have to be reading. You have to also find out what is going on in the market, discuss with other investors, read news on investments, listen to some of these news, get these newsletters so that you're up and abreast of all information going on in a particular sector, in the oil and gas, in the health sector, in just name it. So I take you to the next slide. So we have the Sanders approach process. It's called the one rule, four step approach. It's a process. You don't just wake up and make money. It's a process. And that's why success is termed a journey. It's not a destination. For you to make money, it's a journey. It's not a one-time thing. You sleep and you wake up, you've made all the money in the world. No, it's a process. You must start somewhere. And that's why I call it the one rule, four-step approach. I'm going to be taking, I call it SAGE, SAGM, Sanders approach to growing your money. I'll take you to the next slide. The first step. You can see money flying all about. Great to have such. That's when you invest rightly, then you can smile. You can see your money growing, having wings, and they're producing and they're just, increasing. So we'll move to the next slide. So the SAGE, I said we have one rule, four step. You must understand what is your vision in growing your money. You have to be clear about your why. Why do you want to invest? What are your plans? What is your vision? Are you saving money, investing money to buy a real estate? Are you saving money to buy a real estate in the commercial sector? You want to buy a shopping mall? You must understand your why. What do you intend to do? Do you want to help the homeless? Do you want to build schools, institutions? You must understand why you want to grow your money. Set specific goals, like I rightly said. We've just gone beyond money, goals just being smart. You know, a lot of times we say, oh, your goals must be smart, your goals must be specific, measurable, achievable, realistic, and time bound. Beyond that, our goals have gone just being smart to being smarter. Sometimes we find that the goals you've set, you need to go back again to evaluate them. Sometimes you meet your goals in 6 months. A yearly goal that you've set, if you meet it in 6 months, what do you do for the rest of 6 months? You have to go back to evaluate your goals and add more things to it. And that's why we call evaluate your goals and revise it. That's the ER to smarts. We've gone beyond just goals being smart to smarter. So we evaluate our goals. And sometimes you find that the goals are like, oh, I need to evaluate these goals. Oh, I've already achieved all I intend to do. Maybe you want to make $100,000 in 1 year, and in just 1 month you already hit your $100,000. Are you going to just waste 11 months sitting not doing anything? You want to go back to your goal. That's your vision board. You want to go back and evaluate your goals. See what you can add to it, how you can increase, evaluate it, and revise it. Your 100,000 can become $1 million for that year because you already achieved it in 1 month. So shift your mindset. You must have a growth mindset and not a fixed mindset. Be flexible. Be ready to take information. Be ready to also, grow, by also doing your research. Thank you. I move to the next slide. Next slide, please. So in this, we're talking about SAGM. That's I told you about the one rule, first step. We're in the step 2 of managing uncertainty. You must seek to understand. These are points you must know. It's called the STG. You must take small risk. Give yourself permission to make mistakes. I've read several books that will tell you mistake is not an error. It's another way of doing things right. And give yourself rooms to make mistake. Be ready to take risk, no matter how small the risk is. Be ready to take risks that you're able to take. Seek to understand. Do your research. Do your findings. Find out what is going on in the market. Find out what stocks are good, what investment to go, what do I go into, buying real estate? Do I invest in logistics? Will logistics in this time pay? You find that in summer, a lot of people are moving, and you don't want a business that is seasonal. You want something in and out of season, you're making money. So you might want to just read while, and meet with other great minds like yourself to share ideas and see which will work. Then I take you to the next slide. Yeah, and then we have set up a funding system. We have brokerage accounts, fund the accounts. You might want to create a brokerage account, an account that you get to use for stocks and others. You need to fund the account even after creating those accounts. You have to decide how much you're willing to gamble each month. You might want to decide every month, I want to put a certain percentage of my salary or my paycheck. If you're receiving maybe, I don't know, let me give a guessing, a $10,000 every month, you might decide that every month I want a certain percent, 10% of my monthly income to go into my brokerage account. I want to be able to grow it. So you might decide how much you're willing to gamble each month. Automatically, the last one is transfer that amount every month from your checking or direct deposit. This is a great way of investment. I would also tell you my story in this aspect. I started when I left college. What I was doing was I would go to a microfinance bank, make borrow some money, take some money from them, buy into stocks. This is what I did. I and my husband, we did that for a certain period of time. Aside from the money market, the treasury bills we invested in, We invested so much in different banks, and as at then, I we needed to change our car. Rather than go borrow money or look for funds, we were able to then sell our stocks in the GTB bank because we invested in several of these stocks. But we found that the GTB was doing well as a day, so we were able to sell a chunk of our investment there, our stocks, and we're able to get a car for ourselves. So beyond that, you want to put a certain amount. And what I did then was I took a loan for a yearly loan that I have to pay every month. And so this helped me not to squander my money. So once I get my paycheck, I already know that I took a loan from a bank. So a certain amount goes based on my standing instruction. So that whether I know it or not, a certain amount is gone already. So whatever is left in the account is what I'm left to give my tithe on, to spend for the month, to do my running costs and everything. So this is a way of saving ahead. That means I took the money ahead of time. So I took this money beginning of the year. Let's assume I took $1,000 at the beginning of the year. I've invested this money, and this money is yielding already for me. So that means for the 12 months I'm going to be paying them, my money is already working for me before time. I've already started making money from January. So that means once I get my paycheck, I just pay them a certain amount monthly. And in 12 months, I'm done in paying them. But I've already engaged the money at the beginning of the year. So the money is already working for me. My investment is working for me. So beyond that, that's why I said you must set a brokerage account. You have to fund it. You have to decide how much you want to be giving. Maybe every month you want to put $1,000 to your brokerage account in order to invest and diversify in all the stock markets. And you must put a standing instruction such that it goes straight from your account. Whether or not you remember, it goes every month. You already set it in an auto run. I move to the next slide. That's the step 4. Build ownership. What I mean by building ownership, you must take ownership in whatever business you do. You must create a company ownership list. What are these company you want to invest in? Use the free research tool on your brokerage account, because a lot of times when you create a brokerage account, there's a lot of information there. There's a research tool on the brokerage account. You might want to use it to gather more information. Are they public? Do they pay dividend? Do they pay dividend? You want to find that in the brokerage account. Is the business public? Is that company public, or is it a private stock sales they had, or is it a public one? Do they pay dividends? You want to find out how often they pay dividend. How much does it cost to buy into them? Then you have to decide which stock to buy. That's why I'm talking about building ownership. Don't wait for people to give you all the information you need. You have to take ownership. You have to build ownership. You have to be, in control of your money, because it is your sweat. It is your life. So you have to work and, decide which stock to buy, how much to spend. Set up a buy order to execute automatically. You might have gone through the stock, know which company is doing well. You might set a buy order and say, okay, once this money comes into my account, you can buy this and buy that. So you might want to buy and set up dividend reinvestments to consistently, repurchase for you more shares over time. You might want to set up a dividend, because a lot of times, most of these companies pay you a dividend. So when this cash come out, you don't want the money to come personal to your account. It goes straight into your brokerage account. So you might set up, an automatic repurchase. Once the investment, once the dividend comes in to the account, the money is used to buy all the stocks, just to build further stocks, buy for more stocks, increase your earning capacity. Then I take you to the next slide. So what are your guiding principles? What are your guiding principles? These are guiding principles for me that you might want to look into it and see if it's something you want to embrace, or you might want to create or tweak it in a way to suit your own. You have to keep it simple. You have to do your basic research, and you have to give yourself permission to make mistakes. Like I earlier said, take long-term goals. You find that the longer you're able to wait, you make more money. You also need to diversify. I earlier said this word. You need to take a little time at a time. Take a little at a time. You don't do everything in one day. You might want to put investment just to see how the investment grows. Public opinion drives stock prices. Yes, you might want to find out what the public opinions, and because you find out that a lot of times these opinions drive stock prices. Don't try to beat the market. You might not be able to. 'Cause a lot of times I have friends who are like, oh, this is a great time to buy in. Oh my God, you just get in. And you find out there's a recession. Everything comes down. You're like, oh my God, I thought I was going to make money this time around, and that's why I went into it. No. So, but do your research. Once you do your research, you're more comfortable, you're more confident in investing. I take you to the next slide. Don't look for the one in a million stock, but look for investment with fairly good returns that you can hold on for the long term. Some people want, oh, I want to just go into this investment. I just want to make this big chunk of money and just zap. And sometimes those 1 million, one in a million stock do not just come all the time. And sometimes when they come, I don't want to say anything negative, but they end up not being what you expect. They might just crash the next moment. So you might want to look for fairly good returns on some of these companies that are stable. They've been there for years and they're making money. Yes, the returns might not be so great as you want, but beyond that, you might want to just stay with these ones because for a long time, the longer you wait, the more you make more money. So I take you to the next slide before we call it a day. Next slide, please. I think that's all for today. I want to say thank you to everyone who has joined me on this class. Perhaps you have a question or two. You can always reach out to me either by leaving a comment or sending your question. I will do my best to get back to you within the next 24 to 48 hours. And in summary, your money can work for you while you're sleeping. I have tried it. I have done it in several things. I've diversified. I bought into stocks. I bought into land. I've bought into like maybe I built. I think I did one. We did a building and we sold. We sold eventually. So there's so many things you can do, but you can start. It is said that a journey of 1,000 miles starts with taking that baby step today. So you might want to start today. And some people are like, oh, it's so late for me. It is not late. Who tells you it's late? So you start now and take those baby steps. You will get to where you want to be. I earlier said the best time to have ever planted a tree was 20 years ago. But the next best time to is now. You might have to make that decision to move now. Decide on what you want to do. Take a step, move gradually. Be ready to make mistakes. Mistakes are often part of it, part of the journey to success. If you're not ready to make mistakes, then you're not ready to be in business. You're not ready to make money. So you must be ready to make mistakes. You must be also be ready to lose some money. So you must be ready. But find out what your ratio, your risk ratio is all about before going into any investment. And also start small and grow big. Start small and grow big. Before we call it a day, I want to check if there's any question. I'm going to leave this in case you need to reach us. So thank you. Looks like there are no questions. So let's call it a day. Do have a nice evening, a nice weekend. Until our next episode in Money Matters Live. Do have a blessed and a restful weekend. Bye.